Hey, everybody, welcome back to another beautiful day in real estate. Today, we've got a lot of stuff to cover. We're going to talk a little bit about what's going on in the existing housing market because everybody is very, very concerned about what to expect. What's going to happen? What are you going to be looking into for the next couple of months? So let's just jump into interest rates right away. Interest rates, you guys, are coming down slightly today. So we did figure out, yesterday I said, man, I don't know why interest rates are going up. Well, it's really just because of how bad the bond market is currently. There's a lot of bonds being sold and trading is going on so that there's more capital available to start purchasing oil at higher prices is what we're starting to witness. I'm also noticing that because the Strait of Hormuz continues to stay closed, we're seeing more and more strain on different parts of the supply chain. Mainly the biggest one that I've noticed, I was going to talk about this last, but since we're already here, is fertilizer. That's a big concern right now. Fertilizers are up 44% since the start of the Iran war. This comes as a 33%. Globally traded fertilizer passes through Strait of Hormuz, which remains effectively closed. So again, we've talked about this before, but the main issue is not just oil. It also comes with the products that come with and through the Strait of Hormuz. Fertilizer is a humongous thing for us, right? We need to have more fertilizer to grow more food so that we can essentially continue the supply chains, right? I've mentioned it before and I'll say it again. I do believe that one of our pandemics that may come up, and the crazy thing is a pandemic is just going to be part of life in the next few years, it seems, because everything is getting tighter and tighter and tighter and tighter. And at the end of the day, famine, that's the big one that concerns me. Supply chains are getting tighter. We're seeing less and less farmers. Now, granted, there's still farmers out there doing the things and whatnot, but the crazy thing is that we're not seeing any sort of relief as of right now. We're just continue to see everything continue to go up, and people are struggling more and more and more and more. And the fertilizer portion of it is just crazy to me because seeing a 44% increase since the start of Iran war, that's 2.5 months, and we saw all of this happen at once, right? This includes a 23% of global ammonia and 34% of urea, the world's most widely used nitrogen fertilizer, and nearly 20% of global phosphate supply. So the Strait of Hormuz is effectively cutting off at least 20% of products coming through right now, and that's going to put a big pressure on people and companies and businesses and farmers. Until we can have some sort of structure behind that and start to see a stability again, prices are going to keep going up. It's not just gas prices that are costing more. It's not just a plane ticket to go fly somewhere. Everything is getting more expensive. And that's why, again, I'm so adamant about making as much money as I can in this market and then going from there and investing, right? It's important. So that was the first thing that we noticed, is that the Strait of Hormuz needs to effectively open. Otherwise, the longer it stays closed, the more disrupted the supply chains get and the more issues and more price increases we're going to continue to see. So conversation for the beginning of the day is already over, right? So next, let's talk about the S&P 500. The S&P 500 did have a nice little rebound yesterday. As we kind of talked about, it needed a little bit of a sell-off, and then we saw a major candlestick open up this morning. We're 8 minutes into opening market today. Like I said before, there's a good possibility that this is going to get touched again before we see anything crazy again. I guess maybe not, maybe it will, but to me, it just seems like that's a very good possibility. So like I said, it just depends. It just depends. But right now, the market is still moving upward, and there's really no positive momentum on why it should be moving upward. There's no direct storyline. Nothing really is pointing saying, hey, things are good. The prices should be up right now. So it's good to pay attention to, but I still think that there's an opportunity for a blow off top in that S&P 500 this year. We'll just keep playing it by ear as we go through it. Oil prices. So again, WTI crude. Why don't we just look at Brent crude today and just see where we're sitting the difference, because I'm just kind of curious right now. Let's see, Black Bull markets. Let's do this. Okay. So anyhow, I mean, we're crude oil. I mean, Brent. Let's pull it up. Spot there. Let's try that one. Perfect. There we go. All right. Now we're at one. Okay, that makes more sense now. Okay, now we're at $109 a barrel for Brent crude oil. Excuse me. Let's play around here a little bit. Let's see. We've got a top here. Boom, boom, boom. Let's get the resistance point. Let's talk about, let's see, supply. Arguably, that could be considered somewhat of a resistance. Arguably, again, not necessarily looking for perfect lines here. I'm just trying to put something on the charts for us. Not a bad spot right there as well. Okay, well, in quick glance and seeing this stuff in the last month and a half, essentially, right? Last 2 months, we're seeing that it's kind of bouncing off of that 113 range, currently sitting at 109, peaking at 120, and moving back down. So my guess is we're probably going to see a resistance off of 113 down to 100. If it breaks below 100, we'll see 92, and if it breaks below, then we are obviously in a way better place than we have been for the last 6 months. It's interesting to see, but it sure to me it sure looks like we're going to be seeing. To me, it just seems like we're going to be seeing this consolidation for the time being until something changes. They keep saying that we need to meet a deal in the Strait of Hormuz, and effectively yesterday, we did notice that they were talking. What did Iran came out with right here? So breaking U.S. oil surges above $100 a barrel after Iran's supreme leader ordered that enriched uranium must stay in Iran. Removing Iran's enriched uranium stockpile was the core of the U.S. demand for ending the war. So right now the negotiations are stalled because the current supreme leader of Iran is saying that he wants his uranium to stay there, or their uranium to stay there. Trump is saying that he wants that program to end. So until we see some sort of security, which to me at this point, my anticipation is we're just going to keep seeing some back and forth and volatility, right? But above $100, below $100, above, below, like kind of a consolidation, just a wave of up and down, up and down, up and down. Traders are having a field day with this right now because, quite frankly, you don't need a lot of smarts to figure out that the market's going to go up, and then when the market pumps, you're going to expect something to say, "Oh, well, actually, we're not quite to a peace deal," and then it's gonna, well, vice versa. Then it's going to go up, and then you're going to say a peace deal. It's going to come back down, and it's going to go up and down, up and down. This doesn't really surprise me. It just means that we have to pay more attention. We have to be witnessing what's actually going on here for the next 6 months, right? So my guess is that we're going to start to see oil prices keep going up, slightly ticking up. I mean, there's not a whole lot of saying otherwise. Like I said, there's not a lot of stuff going on to really say that the market's going to rip one way or the other. It's pretty neutral right now. As negative as everything seems, there's nothing like directly acting as a story that's just going to blow everything wide open and go one way or the other. So for me right now, I'd say let's just stay optimistic because nothing's really pointing negative as nothing's really pointing positive, right? So I'm always going to stay positive unless there's a reason not to, right? So also we're witnessing the amount of issues with the bond market. The bond market is seeing significant increases. Again, we were at 4.62. We peaked at 4.69. And if you guys know, the most recent high was up there at 4.8. And then before that, we were all the way up to about 5.01. Let's pop that in there because now it's not too far out of the possibility that we're going to see that if things continue to head this way. All right, we're seeing a little bit of resistance right around that 4.61 range. But, I mean, hypothetically, you saw that peak high, lower high, and then it closed down pretty significantly. We're kind of going south. Hypothetically, my guess is we're probably going to see this continue up for now, probably to 4.8. The 30-year Treasury bonds at 5.14. Everything's kind of just moving up right now, man. Nothing really looks good, and you're noticing a lot more countries are selling off the U.S. Treasury bond because right now it doesn't make sense to hold it. It's a higher risk asset or higher risk, and there's a lot of cracks in the bond market, which is causing a lot of disruptive conversations. So until we see that stuff kind of transition again, right now, like there's really no way out of this. It seems like no matter which way we look at it, the chances are of interest rates coming down are becoming slimmer and slimmer and slimmer. And the chances are of us starting quantitative easing again is very likely. We're going to see the money printers get turned back on. We're going to buy our own debt to solidify the fact that if we don't, then we're going to see a major implosion in the market because bond markets are going to collapse. If bond markets collapse, we're in for bigger shit than we are now by a lot. So the fact is that we have a strong possibility that we're going to be running into more and more issues with the bond market over the next 6 months, and the chances of them continuously going up is very high right now unless they turn on the money printer, and that seems to be the only plausible way to kick the can down the road again to continue on with what they're doing. I still think that we're going to see the possibility of that happen over the next 6 months. Moving into midterms, they're going to try and lower interest rates, try to push money into the economy, and give people a sense of security so that they can win the election side of things, and then we'll be back to our regular scheduled programming. So with that being said, nothing's looking too great right now. Nothing's looking terrible. However, I'm going to talk more about the real estate market again. So the difference between 2008 levels and 2026 is a topic of conversation that is every single day across the board. Everybody's wondering what's going on. Here's what's going on, okay? Existing homes have already back to the 2008 levels. This happens this is happening without a recession, no spike in unemployment, no credit crisis, no forced selling. I would argue the credit crisis, but anyways, now imagine the housing looks like when real economic stress begins. The thing is that they're anticipating the market's going to crash just because of one statistic. That's the thing. There's only a couple statistics that stand out, and people are like, oh, obviously the market's going to crash, right? Because things aren't looking great. But the reality is, again, is we don't have the issue of supply versus demand. We definitely have an issue of affordability, which is restraining the demand. But we don't have a lot of supply either. That's the problem, right? So, I mean, here in North Dakota, like I said, we're at 1.6 months worth of inventory. That means for 1.5 months, if we stop listing houses, we will effectively run out of houses, right? That's what that data says. But what people aren't paying attention to, nobody is selling these homes. So they're very minimal, right? So even in North Dakota, we're still getting multiple offers above asking price and selling within a week. Most homes are selling if priced correctly, quickly, and if they're in good shape, quickly, right? New construction is getting very, very, very busy right now. Even though interest rates are on their way up, I mean, interest rates are like, again, we're at that 6.67 range again. We're at the 6.2425 range. I mean, these are on the averages. You're more than likely playing closer to 7% and closer to 6.5. I mean, it's crazy to think about, but I mean, nothing's really getting better, but nothing's really getting extremely worse either in the housing market. It's kind of, it's like a flat line in a hospital. So for us, we just have to be paying attention. Okay, over the next, again, I always say 6 months because the 6 months is the effective time frame that you can really plan stuff out and at least anticipate to some sort of an extent. And I mean, I'm expecting over the next 6 months, interest rates will not be dropped at a federal level. No matter what this Kevin Warsh guy thinks he's going to do, interest rates are not going to drop, and they're going to see some sort of liquidity pushed into the market. So I think that quantitative easing is going to effectively resume. They've talked about it before as utilizing it as some other concept. They didn't say it was quantitative easing. They said we're buying up bonds, which is essentially buying, quantitative easing. You're buying up your own debt is what you're doing. You're printing money to buy your own debt, which is devaluating the dollar even more. And like I sat down, I was doing some math this morning, looking at some of the houses I'll be closing, and there's one of them that we had listed for 720,000, built it for $350,000 20 years ago. So respectfully, they're gonna, and I can't disclose the prices or anything like that. Let's say we sold it for 720,000. They're gonna walk away with, well, geez, after commissions, you're walking away with over $300,000 profit just by living in the home, and that in itself dictates to me how valuable it is to own a home right then and there. Because if you're buying a home in a good neighborhood in a good location, you take care of that home and you sell it down the line, you're going to make more money. We have 20, almost 30% equity in our house, and we moved into it 6 years ago in the brink of COVID, middle of COVID. Real estate is a very good thing to be invested in. And then I pulled this up and I see that on a national average, home prices are about to go negative. But we talked about this yesterday. It's specific. The thing is all this data is jumbled into one. So again, if you're comparing a Bismarck, North Dakota to a New York, New York, you're looking at two separate different housing markets. California versus South Dakota, Washington versus Florida. You have different markets with different things going on. I know data like this is scary. Home prices are about to go negative in all caps, right? But here's the thing. We still saw increases here in North Dakota last year. In fact, we saw above average returns since last year. 6.7, 6.9, and 5% increases. I think 3.9 was the lowest in my area. So on average, people are gaining 5 to 6% in equity in North Dakota right now. Why? Well, because a lot of people are moving here because there's an affordability issue. And in North Dakota, the median price income versus the amount it costs to be in a home is relatively where it should be. It's at about 36 to 37% of the average person investing the amount. So let me clarify. About 35% of somebody's income, net income, is being used towards their mortgage, which is about where it should be, about 30 to 35%, right? 36, 37%. We're still relatively in that comfortable bubble. And the cost of living here is substantially lower because there's shorter commutes, there's less stuff going on. Taxes aren't great, but they're not great anywhere. They're not extremely high by any stretch of the means. Homelessness is very, very low here. Crime is pretty low for the majority. I mean, you see some things, but nothing that's genuinely destroying anybody. And that's why a lot of people are moving here. It's affordable. It's safer. It's comfortable, and that's what people need. That's what people are seeking in a world full of chaos. They want comfortability, right? Now, that's the thing. Markets aren't exactly collapsing yet, but everybody is kind of witnessing and concerned about the market just imploding, and the whole thing is going to go chaotic and whatever. But let's be real here. We're not there yet. We're not quite there yet. over time, yeah, the market might go down, but I still think we have bigger issues. We have credit issues, we have debt issues for our credit crisis, private credit crisis, we have auto loan debt, and we have student loan debt. All of these items are going to be an issue over time, but nothing that's going to directly correlate that's going to crash the markets today, here and now. But those three debts are the biggest concern right now because they're the highest they've ever been. The delinquencies continue to go up, and now we're starting to see this conversation of the bond market starting to implode. I mean, all of those things will directly correlate, which will crash markets over time. But the thing is, like I've always said, there's never been a time in history where you haven't bought a house and 10 years later it wasn't worth more than what you bought it for. And that's the thing, right? You're investing, yes, you're paying interest. And I don't know why everybody became such a big argument over interest. And we've been paying interest for insane amounts of time. The thing is just like everything else in history, you used to be able to buy a home for a 10-year mortgage, then 15, then 20, then 30. Now 30 is the average. Now they're talking about bringing in 50-year mortgages. You used to pay 15% for a mortgage on a house. Now you're paying 5, 6, 7%. People think and see this, and the thing is yeah, even though interest rates are lower, you're actually paying more in interest over time. But at the same token, you're also seeing equity gain in your house. So the problem is that for whatever reason, we're being convinced and programmed to believe that buying houses isn't a good idea because, well, interest rates are bad or prices are too high or whatever your argument is. But here's the thing. My clients are all gaining equity over the last year. Again, it's very particular to the market you're in, but in North Dakota, we are seeing steady growth. We're seeing more jobs. We're seeing bigger things get taken care of. And more recently, I saw a company talked to a company that's building a data center here. They're talking about 1,000 people are going to have jobs here for the next year. 1,000 people. You're going to see an increase in people moving here because they're going to have jobs here. You have the oil industry, you have the gas industry, you have coal industry, you have a lot of natural resources here that pay very good wages. On average, it's $85,000 a year per household income. People think, oh, it's not a crazy amount, but remember, I lived off of $40,000 a year comfortably. And I mean, granted, I wasn't out doing exotic shit, but at the same token, I was paying my rent. I saved a little bit of money. I got to go do stuff. Went on a couple trips a year. You know, we we're as comfortable as we want to be, right? And in places like here, you can be comfortable living off of a lower paying job. It doesn't have to make $100,000 a year to be comfortable here. Granted, it's nice, but it doesn't mean you have to, right? And that's the beauty of living in North Dakota. But the only thing that really kind of stuck out more recently in the real estate market that I was paying attention to, there was a talk of the Zillow Chicago debacle, and I'll touch on that before we end up dipping out here. But this is what happened. Just the House overwhelmingly passed a Trump-backed bill to restrict companies like BlackRock from buying single-family homes. Long overdue. It'll head to the Senate, then the POTUS desk. See, here's the crazy thing. They don't equivalent to more than like 5 or 10% of purchases. Like, okay, it'll help some, but really, it's not going to change. And here's the thing. Did you guys read the bill? The bill wasn't, it doesn't say you can't buy them anymore. It just says certain entities can't own more than 100 homes. So all you have to do is create another entity and boom, you found a loophole immediately. Like on paper, yay, let's all cheer. But in reality, it's not going to be doing much. It's just another way to say, look, we're here to help trying to help the affordability issue. And relatively, it's not going to do much. I mean, it's the damn truth. But anyways, the last thing that we're going to touch on is the Zillow versus the Chicago MLS. So Zillow has been in a debacle stating that they are only going to list, and right now it's mainly against Compass. They don't really come out and say that, but Compass is arguing that since they partnered with Redfin, they want their listings exclusively on Redfin for pre-listings. And Zillow was like, no. So basically, the argument, from what I'm understanding, is that the Zillow was supposed to list the preview listings on there, even though they don't have a direct partnership with them. And Zillow said, absolutely not. They said, well, if we don't list our preview listings by midnight tonight, which was 2 nights ago, then we're going to remove ourselves. I think it was like 32,000 listings were removed from Zillow just overnight because of that issue. I just think we're going to see a lot of shifting in the MLSs, and it's going to lead to a national MLS. And more on that in the next video. But today I just wanted to jump in and kind of showcase, like, you guys, everything's not hopeless. We just have to strategize a little bit differently, organize differently, and find a different answer to a solution. It's not going to be life-changing. It's not going to be life-altering, but it's going to be great to understand. So with that being said, we covered a lot of stuff today. If you have any questions, make sure to comment below, like and subscribe, and we will see you